Hello, Warriors. How's everyone doing? Hi, AJ, Alicia, Trade Journal, Sinatra. Hope everyone has a good day working for them. Ryan, how are you?
I'm good, thank you, Dale. And you?
Good, buddy. Is it Friday?
I wish.
Okay, well, can you see my screen, bro?
We can, mate.
Okay, so I feel a little bit like a broken record, but the narrative I was talking about for 10 years yields a squeeze towards 10%, 3%, 10%. Boy, that'd be something.
That'd be trouble.
Yeah, so we're there, but I'm always ready, especially with Fed minutes, to shift. And part of the scenario was with 10-year squeezing that it would be supportive for the yen and maybe enough for the yen to take out this prior high that we had in the 136 range. We'll see. Thought that, maybe we could even get near 137 handle.
Yeah.
And with that happening, that gold would continue to decline maybe towards 1740-ish and silver towards 1940, 1920. And the only thing that's pretty different today is S&P's finally responded. Blake shorted it on Turnaround Tuesday, and it's working. Didn't make it easy for you, Blake. Did it because kept grinding, looked like it topped, and intraday it made one more spike up there right here. But I think that now this is underway as well for a top that could take us down to 4,100 or so, maybe 40.50. So I think that now everyone's going to say the 200 contained it. So I think we'll get something out of it. I was wondering what your thoughts are, Ryan, with Euro trading down here. I would like to buy it once we take out this 101.11 level. Figuring maybe we could trade under that because
Yeah.
there was a lot of stops under 101. You have a view on Euro? I know that you thought it could be a good trade this year. It's August.
Yeah, I'm running out of time for that one, aren't I?
I mean, so did I. How time flies, so
Yeah, exactly.
Anyway,
I'm glad I held off buying that one and
yeah,
stuck to Euro Sterling.
yeah,
I actually made a bit of money on. I mean, you remember when it was up at 108, so I didn't fancy buying it up there.
yeah. I remember.
And I think
But
we're
are
in a
we
bit of a
bottoming here? Is the big, I guess, and the bigger question is all of this work that it's done here, and I know this looks
yeah.
like a feeble rally that failed at major resistance, but is it possible that this is, it's under accumulation here? I mean, people, still are pretty bearish. I didn't see the euro
Yeah.
get above like 45 or so on the DSI. And I'm thinking, maybe around this 78.6 level, par 40, par 70, that it
Yeah.
might be worth a shot and then risk the lows.
Yeah, it's a difficult one, isn't it? You don't want to buy it, but you don't really want to sell it down here, do you? Unless you're playing the sort of short-term ranges.
Yeah.
The fact that we hit that parity area, but we haven't really come close again, that sort of tells me, what the real feeling is. There's obviously a ton of people who shorted it all the way down, but they just don't want to push it much further, if you know what I mean.
Yeah.
It doesn't mean they want to, turn around suddenly and short cover. We can tell that from the price action last week when it couldn't get through that 103.40.60 zone. That's just it's a big number intraday or short term, but in the grand scheme of things, it's not a big level, apart from being those multi-year lows.
Right.
So yeah, I don't know. If you want to buy it, you need to buy it close to, like you say, down in parity, somewhere like that. Maybe even the low 101s. We can't seem to get through that at the moment. But it depends on your time frame. If you're going for longer term, you may want to sit on your hands a bit. If you're just trading short term, down into 101, up into 102s, 103s is where you set your stall out.
Or if you just want to be Steve Volge, you just wait for closes over 103.50. And forget it.
Yeah.
Forget everything else in the meantime, trying to get the edge and wait for it to prove itself.
Yeah, exactly.
Don't you think? Any news on the yen, or is this just related to 10-year yields heading up? Kind of looks like, we're going to get this ABC.
There's a bit of a yield story around. I mean, Kay mentioned it on the Flow show. All yields are up. If you look at yields in Europe, they're up as well. They seem to be running a bit faster than US yields. So, as far as that, if it was just US 10s moving, I'd expect this to be pushing up much higher and the dollar pushing much higher. But because it's, European yields globally are running up, it's a bit of a, negative or what's the word, an offsetting effect in the yield story. So, yeah, you got to look at the European yields as well. I mean,
there are some people think that we could make a run towards 140 in the end. They're thinking that we could, make new highs here. I'm not in that camp. How about you, K-Man?
All right. Good morning, everybody. Good morning, Dale.
Good
I'm
afternoon,
not ruling
bro.
out anything. Really, right here and now, and as I was saying as well, there's the global yields pushing yen lower. It's the European yields, gilt yields have been pushing higher as well. And since European yields have actually run a little faster than the dollar yields this morning, it keeps euro from going lower, and actually euro has pushed quite a bit higher against various crosses under which the yen. There's a bit of a level there around 135.60 that I'm watching on the dollar yen, and on the underside 133.90 really. So we've got like 170 points to play in the short term. But since all those yields are keeping up, and the Japanese government is rather doing the Bank of Japan's job right now by pushing more stimulus, adding 33 yen per liter to the gasoline subsidies. I think the market is really strongly now again using the yen as a funding currency, and against all the rest. That's what driving the yen up. Euro, I'm pretty neutral right now, although I'm tiny short because I still think euro. I'm a bit short through the process as well, as I think the weight around the euro's neck will sooner or later show up again. The situation in Germany is not improving at all.
But the interest rate scenario you just described is a different tone that I've heard from you since we've been working together.
It's a bit different because we had those yields propping up at the same time. The market is really expecting for the ECB now, due to inflation, and we must admit the GDP. If you compare both GDPs in Euroland and in the US, euro is actually a bit higher in Q2. So I'm a bit cautious with the short euros but overall I still favor the euro to the downside, and sooner or later this I think will catch up after the short covering in the euro process is done. Perhaps euro can drag it lower again. And as you say, for the medium-term player, I think it's a fair plan to say I want to see the euro break above and hold the 103.5 if we talk in euro dollar terms, and for the rest in between it's going to be euro crosses, I think, moving the more than the euro dollar as such, as yields are moving in tandem.
Okay, and crude made new lows. Yesterday it's trying again. There might be a 3 drive around 85. 85 was the target for a lot of people, 80 to 85. And you would think that Canada should already be like 132, 133. And, we're not even above last week's highs. And really, when you look at it here, it's pretty strong, which means USD CAD is pretty weak. I would welcome an opportunity to short it up here like at 61.8, 30, 34, something like that. So, because what happens if we do get a bottom in crude? Because what's going to happen this winter? I mean, natural gas is already making new highs for the move. So I don't think WTI is going to be that far behind for at least a bear market rally. But crude making new lows, dollar pretty strong this week, and yet Canada hasn't even taken out the employment report high. What do you think of the loonie? Does it drive you crazy?
Another one going sideways, I think.
Yeah, sideways. Okay.
Yeah, and, it can't get above 129 and hold it. It can't seem to hold below 129. It's up and down, up and down. It's a very sideways market.
Yeah, but when you look at it though, and I've talked about this before. I know I have a lot of fibs here, but this was a COVID high, and if you look at the euro's taken out the COVID low, so it's just paired differently. That CAD looks really pretty corrective, just as Aussie looks pretty corrective. We might get another shot down here in Aussie, but these two compared to cable, and cable didn't make a new low either. Euro's the only one. So when I look at the commodity currencies, I go, you know what? There's a relative strength if I want to fade the dollar. And that's with commodities under pressure, metals under pressure, oil down, copper correcting. So that makes me think that there's that we need a turn in the dollar for the next phase of a bull market in commodities. And
Dale, I'm glad.
What, bro? Good morning, Blake.
No, good morning. Ryan, go ahead and finish what you were going to say there.
Yeah, so I was just saying, or better news from China, because that's always a boom for commodities.
Oh yeah,
I actually believe that you have to buy these commodity currencies on a dip, and I think I'm glad you brought that up, because you see these pullbacks, and good morning everybody. You see like some of these pullbacks in these commodity currencies, like the Aussie, like the Kiwi. We have the RBNZ yesterday. The Kiwis, pulling back a little bit. I want to use these pullbacks as an opportunity to be buying, and I think you bring up a great point regarding the Canadian, where you're seeing really more of a consolidation. I'll tell you what, I just got out of a dollar Canadian long overnight, and I traded it really poorly. Here, I'll go ahead and take this, buddy. Here.
Well, it looks like a little head and shoulders there right now. Anyway.
Well, first of all, I'll kind of take you guys into how we traded it last week, and I'm gonna have to go give a hat tip to our one of our community members, Steph. I know I mentioned this yesterday or maybe Monday. I went in and bought the dollar Canadian. I wasn't even looking at it, and
I'd like to interview Steph. Maybe we could set it up, or someone in the community.
She might be up for it. But you can see, like yesterday, I guess it was yesterday here, I took off 137 pips out of the dollar Canadian, and I took off the Norwegian krona. I took off a loss for the dollar Mex. I got out of the rand, and then yesterday I went out and I rebought it, and you can see it right around. Well, you can see I was trading it on the long side yesterday, and I was down about 20 pips there, and it actually slipped even further. I was thinking that we were building some sort of bull flag pattern here, and it slipped below, but I didn't want to risk below this, this previous neckline of the inverted head and shoulder pattern that you can see right here. Right, this is the previous one from last week that we capitalized, and like I said, a hat tip to Steph for doing that, for pointing that one out. Anyway, I played it on the long side, and I just got out of it this morning up here, for a small gain. And by the way, if you guys are not in the ForexAnalytix chat room, I'm just kind of giving you a brief overview of, and these are just my trades, but you can see other people place their trades in here. But this morning I closed it out. right there, and I just took like 12 pips out of it. And I noted in the chat room, I poorly traded the dollar CAD, and I feel lucky that I actually booked some profits. And the fact of the matter is the dollar Canadian, as Ryan pointed out a little earlier, it is extremely choppy. It's hard to read right now, and I don't have a good feel for it. And when I dip my toe into a market like that where I'm not like super comfortable with it, I noticed that I really, and just I get very lucky when I trade them, or sometimes unlucky too. And that happened to be the case with the dollar CAD. But I think over time, what you're pointing out, Dale, and I have to agree with you, is you can see this Canadian, I guess you can call it a sell-off a little bit over the course of the last few months, I'm sorry, since COVID, because we were talking post-COVID move. Yeah. Since middle of last year, this is a daily chart, just really compressed. It's really corrective.
Yeah.
Right. So, I mean,
it worked off its oversold condition more in time than price.
Right. So I would think that the next move is going to be, much lower at some point. And, that's, obviously, we'll if you look at the Aussie, it's very similar, right? We had a very bullish move, corrective, and longer term we have the Aussie dollar. You guys all know that how I feel about this is a long-term Aussie dollar inverted head and shoulder pattern. So that's why I've been all year a buyer in the Aussie dollar below 68 or 70 cents. I've been trying to buy it on dips. So Ryan, Cayman, how do you guys feel about buying the commodity currencies on dips in this environment? I know it's hard because you have stocks that just came off of a massive rally from the lows. So I know you're probably thinking at this point, I don't know how hot I am about buying the Aussie or other commodity currencies on any dip right today, but I'm talking about maybe over the next couple of weeks. What do you guys feel about? How do you feel about that idea? We'll start with you, K-Man, or Ryan. Sorry.
No, K-Man, can I have it gone?
Yeah, I'm not sure if I want to buy them right here and right now, but if you're talking about weeks, I think for the Aussie, for instance, anywhere close to or sub 69 looks quite attractive right now, just on the price action. But I really want to have a look at those how those commodities behave, because the rejection which we had, you call it particularly on the Aussie dollar from the mid 71s is equally pretty high.
That was right at the 200-day moving average. In case you missed it, I'm not saying you. I'm in case anybody that's listening in. That 200-day really capped the Aussie on this rally.
Yeah, I had a pretty good run short Euro Aussie in that move, but then for some reason when I looked at the commodities, I took my profits and then ran because I also didn't know what was going to happen after the RBNZ. And as a matter of fact, we had bid in both. We had exactly as we said a couple of times, the buy the rumor and then sell the spike on the rate hike. So here and now I'm a little cautious, but in the next 60 to 70 points I may be getting interested after the US retail sales, perhaps for a try long. I still think it's tough to look weeks ahead, but it may be a very good trade indeed.
Yeah, I'm going to get you a crystal ball for Christmas, Cayman.
Another one.
Oh.
So Ryan, how do you feel about about these commodity currencies? Do you still want to buy them on dips? I know you were pretty constructive on like the Aussie and other commodity currencies before, but how do you feel about them now?
Yeah, I mean, I'm in a similar vein as you. I mean, as you know, I was trying the longs when we were dropping from the 74s, 75s. with a bit of success, and then obviously we broke the 70s. It does need a big turnaround in sentiment. I think the dollar has a lot to do with it. I would have expected the dollar to be weaker, commodity currencies like the Aussie and everything to be higher. And yeah, I'm getting a bit itchy that to look for any decent dips to start getting long again, maybe for a longer term trade like what you're doing. Because I think there is a prospect of things turning around. Once we know rates have topped, once we know how economies are settled down, I think we've got a bit of a bumpy road coming. And as we've been talking about, China is the potential extra bumpy road for global growth. That's going to be a big weakness for commodities and commodity FX. So in my opinion, I can see commodity currencies heading a bit lower before we start to then turn up a bit.
How do you see China right now? I mean, here we got with
a satellite.
Xi Jinping. What? What's that?
I see China with a satellite.
Oh my gosh, the dad jokes are strong with Dale. So
Ryan liked it.
We have an election coming up here in the next couple of months. They really, it's amazing that they are still really. I mean, people are still paying attention to COVID numbers in China. I mean, it's pretty. Yeah. It's pretty wild. I mean, that they are, and I'm not, sitting here trying to downplay it, but like we don't just because I live in a place that people just never cared about COVID really in the state of Arizona. We were
all kissing each other.
We were like, give me COVID so I can get on with my life.
Yeah, COVID parties.
That was everybody's thought process here. But I mean, I'm just saying that. Here in the U.S., the CDC, kind of, wiped that away, and here people are still paying attention to it in China. So it's really interesting. Do you think they're going to continue to slip on growth?
Yes, well, it's possible. They've already shut down 2 regions manufacturing to protect domestic energy supplies, electricity. So you've got 2 regions. Jingzhou, if I'm saying that right, and Sichuan, who are for the next 5 days have cut their manufacturing output because of a big drought. So that's going to impact activity. The funny thing with China is you can see negative data and the market gets all, global growth cold and everyone sneezes and commodities get smashed and everything. And then China turns around and chucks unlimited amounts of stimulus or measures or infrastructure spending, whatever you like, and it all turns around again. So I think we might be heading for that sort of scenario again, where the world think China's going down the crapper. It won't happen, and then that's when you want the swing.
All right. Well, thank you for that input. And we're about 7 minutes away from the retail sales, and I want to talk about that here in 1 second. But I want to mention that if you guys want to hear K-Man and Ryan, who was just speaking, in the mornings, or I say in the mornings, for me, it's in the middle of the night, but for the Flow Show,
Greek guy,
what's that? And the other Greek
too.
and the Greek guys, we got Steve and Stelios that join in. Steve actually took over for the Flow Show while these guys were out of town. But now that they're back, I'm not sure if he's popping in there. And then we have Stelios. He's out of town right now, or out on a beach, and he'll be joining them again. But the Flow Show, it does broadcast in the middle of the night for me. But if you guys are trading European hours, make sure you guys log in. It's free. Then obviously the F.A.C.E show here. So, I did want to mention that. And we have, like I said, we have retail sales. So what, since Stelios isn't here, he was making a big stink about it last week about retail or U.S. consumers. Credit card spending is, going through the roof here as people try to keep up with these inflationary pressures. I have a feeling that this data is going to, start to show a little bit of weakness. It's going to start to weigh on the consumer. I don't like betting against the consumer here in the U.S. Being an American, they tend to buck all trends when it comes to spending. It's still quite mind-boggling to me. But we have, you know, when I try not to bet against the consumer, but I do feel that these inflationary pressures are really starting to dig in and weigh on the consumer, where they are using credit cards to buy necessities and you know, keep their cars, you know, fueled up and putting food on the table for families. And as a result, you know, we're starting to see the stock market show some signs of weakness as we come off that 200-day moving average. You guys know this is big resistance. I couldn't have yelled it off of any other rooftop over the course of the last couple of days, you know, with the week ahead videos and Twitter and everything else. We are facing some really major resistance. However, I don't know about being super bearish here, because if the number comes in a little bit light, you know, we could get another look at 4,300 today. Do you guys have any views here? Because I am bearish stocks, and you know, K-Man, you and I were having this conversation in the chat room, by the way, a little bit earlier here. If you guys want to see like some of these conversations that go on in our chat room, I'll just show you this. Oops, not discussions. Let's go over to the threads. K-Man and I were talking this morning. You can see this. And K-Man, I'm gonna read your message to everybody so everybody can see what we're talking about. It's starting to have missed opportunity feelings above 4,300 as I was watching 4,340, 4,360. And I'm like, yeah, I'm not aggressively short as I want to be. Retail sales could be a little light, and we could be right back at 4,300 today. And that's how I feel. It's like I feel that, you know, if the data is weak, we might get another looky-loo at 4,300. What are your thoughts there, K-Man? Since we were having this conversation, what are your thoughts there?
Yeah, I think I was watching that zone as I was saying, more because of a timing than I was. To me, the end of the month, and we got OPEC still this week, and then the end of the month, it's going to be important. And I will be getting interested if we trade above 4,300, towards that 43, 4060 into the end of the month, also because QT kicking in next month. So to my personal view is that September may be a little more difficult for. Come September, it may be more difficult for stock markets. That's my personal view on that one. It's following the yields now, with all the major yields up. They're coming off now. I don't know what OPEC is going to do, but yeah, my overall feeling is around that red trend line. You know, that's where it is, around there, 43.40 and stuff.
Yeah, and then, you know, we have this I want to just make sure I show this to everybody here. This is 127% extension of the last move lower, comes in right around, let's just call it 43.50. It's actually 43, a little higher than that. A 618 retracement of the all-time highs to the to this year's lows comes in right around 43.50, 43.60 as well. This big resistance zone, I think, is going to be very, very critical for the market. Ryan, what are your thoughts really quick? And Dale, I'd love to ask you too before the retail sales. Okay. But Ryan, what do you think about this 4,300 level? You selling into it, or do you think we can still, you know, get a little higher?
Well, I've just been stopped on along. I sold a small pinch yesterday as we were testing it, but that was after I put some buy stops in at 43.05 and 15, because I thought if we get a break above the handle and the 200 daily,
you were going to play a little cheeky long there.
Yeah, a little cheeky long. And I've been stopped out at 17 not a few minutes ago, so that hasn't worked. You know, it's proving a solid level. I thought the break up to the 20s was the kicker, and that was going to kick on from there. You know, get a little bit of a stop run through, a little bit of a, you know, late buying, but it hasn't happened. So to me, that solidified the level. And if we see 4,300 during the US session holding as resistance again, it's going to make that level, you know, it's going to cement it up again. But like you say, you know, yeah, you're okay with short, but can you see it going significantly lower? You know, you look at the trend for the last 2 months. It's just been in BTFD mode, isn't it? Really?
Yeah, it has been. Hey Dale, we got less than a minute. Oh shoot, never mind. We'll talk about that here in just a second.
That's okay.
We got
Go
retail
ahead.
sales coming out. Let me pull up the data flash, and then let's go look at the. Well, we'll just look at the S&P since we're here. Retail sales is. What do you guys see? Oh, here we go. Core retail sales a little stronger than expected. So, but retail
Flat
sales
on the month,
numbers.
normal.
Yeah,
Headline
that
sales
means
flat. X autos up 0.4, X autos gas up 0.7. But as we've been saying on the flow show, you're going to get the analysts coming out and showing what the real retail sales were. So the adjusted for inflation, which would be negative for the last 2 months. This is, I think, the third month of higher headline numbers, but the actual real retails have been lower.
Didn't I see a report for Target that their profits were down 90% in this reporting period?
Really?
90.
Wow. Yeah. That's I didn't see that. That's a hell of a number. Just so you guys can see the S&P reaction to that. It's, we pushed new lows, pulled back up. I mean, consumers seem like they're spending money on stuff they have to, not necessarily discretionary, which will be interesting. That, speaking of which, we got a young macro mind, radical Adem, who's going to be coming on here this morning, right, Dale?
Yeah, Adem.
Yeah, Adem actually lives very close to me, and I told him last time we met that we may meet up in a grocery store. Just because we shop in the same area. So they're
not arresting shoplifters anymore, just in case you want.
I'm looking for this Adem guy running around, and I'm gonna rat him out. But no, just jokes aside, it's going to be interesting to hear his view. So make sure you guys and gals stick around for that interview. But I want to say that I think you have to be careful with S&P shorts, at least right out of the gate. I'm gonna be looking for areas to actually add to short positions a little bit later today if we can get it. But I want to say, K-Man, Brian, Dale, thanks for all your inputs today. It's good to hear you. And I want to wish everybody good luck today. And if you want to access like the ForexAnalytix chat rooms, you can see our trade room here, our general chat room. You want to access that, you can join ForexAnalytix for $1 for 10 days just to try it out, or you can jump in the trader funding program. You can trade our money, learn how to trade our money. And when you join this program, you actually get access to ForexAnalytix Premium, because we don't want you to try to access our money without having our support. So check it out. There's a video right at the very bottom of this page. They are our webinar and sponsor today of this show. So Dale, team, have a great day.
Yeah, thank you, team. K-Man, Ryan, Blake. Great
Cheers.
talking to you guys this morning. Some elite content. And Blake, just FYI, I'm thinking 4,100, 4050 in S&Ps. Not because it was so strong. I don't think 3,900's in the cards anymore. And Adem, which I know is a Dem. Welcome back to F.A.C.E. How are you? Adem?
Hey, sorry, Dale.
Doing pretty good, bro.
Okay, yeah. Sometimes I mute my mic, but how are you doing, sir?
Good. It's amazing, after we do an interview and we book it out several months, it's amazing how time flies, and here we are again together. So, okay, gosh, nice looking page. You got your website going.
Yeah, I was actually looking at it was interesting when you were talking about Target before I joined this. This is something I wanted to actually bring up while you were talking at. So in the boom phase, for many aren't familiar, there's a really good report it's called the Sherman Simulations. I forget the exact name. I'll find it later and I can put it in the chat. But basically, it was an economist, and he went and he looked at the micro cap business cycle and how it oscillates, like meaning how entrepreneurs like Target, like you said, Walmart, they have to load up on inventory. And in the boom phase, there's like three factors. You have like a time lag, then you have production, like new production coming online, then you have forecasts of the economy. And all three of these are in their own systems, and they're always either amplifying the cycle higher or they're working against it lower. And we always see it. And so in his conclusion, he looked at empirical data and he showed that forecasters' businesses are terrible when it comes to forecasting proper inventory, meaning when prices rise, they load up on inventory, boosting prices higher because of the added marginal buying. Also, new supply comes online, but then it gets to a point like 2020, Fed starts hiking rates. So all these retailers now are stuck with a glut of goods with weakening demand globally. And now they're starting to have to dump. Some of these discounts are going for 30 to 50% off wholesale of goods that they purchased just to, get these things off their book and raise cash.
And sometimes not the size of the inventory, but the type of inventories that they've been
exactly.
Hey, Adam, good morning. Good to
Blake,
hear your voice, by the way.
You too, sir.
It's funny you mentioned this. I'm just going to tell you guys, it just fits right into this. I was over at my neighbor's house, and I had to go grab something from their house. Anyway, his wife comes back, and they happen to be looking for new patio furniture, and she was out at Home Depot, and she's like, oh my God. And she's like, hey, can you guys help me grab these boxes? And we go out to her, her SUV, and she's got brand new chairs and all this stuff. She's like, I couldn't pass up these deals. These are like 50% off these, all this stuff. And she's like, I had to buy it all. But it's crazy because big retailers are just dumping stuff.
Yes, they are.
Yeah. It's nuts. Anyway. All right. Hey, good to hear your voice and good to see you. So I'll let you continue on.
Great. Oh yeah. Thank you, Blake. And that's true. There's a lot of
yeah, Target got that whole thing rolling about a quarter ago.
Right.
Where they got it wrong. They were buying a lot of, stay-at-home stuff, technical stuff, computers, TVs, where people were getting out. They wanted the experiential stuff. They needed clothes, not a flat screen. Can't wear a flat screen to a disco. And yeah. So, okay, so I'm going to shut up here. Tell me what you're thinking.
Oh, no worries. No, and you're right. And these firms, so I see a lot of individuals there, rightfully so. They're, how's the inflation getting so bad? And there's actually another cause that is super underfollowed, underrated, but there's this great book I read recently. It's the Great Reversal. I forgot the author. His name was something Philippon. Great book, but he went and showed how since the 1980s, basically the US and major European companies have become oligarchs. And this chart I'm showing right now here is to give it perspective. Since the 1990s, we saw publicly traded companies peak around 8,000. It's below 4,000 now. That's a 50% drop in public companies. And yes, there are private companies, but we're seeing a lot of private companies merge together, and then they do these big massive deals where they go public. Google Ads runs 80% of the ads market. Tyson Foods runs 90% of the poultry business. The top 5 airliners, and this is before Spirit Air and Frontier, which was a low cost thing, merge. They controlled 80 to 90% of the total air traffic in the US. The top 5 banks control over 70% of the assets. The top 2 beer companies control 90% of the market. And the most egregious one, in my opinion, is that 75% of US homes have only one modem provider, meaning Cox Wireless or whatever you can get. And it's this restriction of supply of new companies.
And no competition. Competition brings down prices, and they've eliminated 50% of the competition.
Absolutely. And that's the important factor, is because the data showed that when there's not competition, meaning there's more oligarchs, a centralized, it's called business consolidation.
Into Russia.
Yeah, it's more or less. And they restrict. So if these companies restrict supplies deliberately, which keeps prices higher, it keeps wages lower, keeps productivity lower, creates investment lower. All 4 factors are, and there's actually another great chart. It shows some hedge fund that bet against, and not to mention these major firms who do lobbying, and it shows them, let me find it, lobbying.
Thomas Philippon.
Yep.
See,
Lobbying
we have an
S&P
educated
500.
audience. Thank you, BR.
Yeah, it's a great, yeah, this is it. This is such an insightful thing. So the firms that invested right here, the firms that invested, they invest the strategic lobbying portfolio. They invested in the firms that invest more in government, meaning they actually, so the government gives their lobbying money to these governments so that they can prevent supply. There was recent data that showed cities with the most oppressive building laws have the highest prices. So their governments restrict building in like San Francisco and Portland without letting new supply come online. And if you look at it, the strategic lobbying portfolio total return, all they did was invest in the top 50 companies index that derive significant earnings benefits from lobbying activity. So for those not familiar, it means lobby power per dollar.
Yeah.
And it outperformed the S&P 500 in a 10-year period by over 60 points. Just investing in nothing great, just those firms that invested more heavily in government, basically handouts and regulations. Because
you think Elon Musk Tesla might fit into that profile?
I'm sure they do. I mean, their tax credit was like a big savior to them, and also he was selling his tax credits to other companies, and it's just really it's really a insidious crony cycle that these things devolve into, because these companies, one of the big theses in Philippon's book was that regulations only kill small businesses. They only hurt small businesses. Big businesses want regulations because it protects them, it insulates them. They can survive.
They can pay the lawyers.
They can pay the lawyers. And here's the real kicker. When you get a big company like Philips and et cetera, growth declines. I mean, we all see it. Like, when you get to big scale, bureaucracy takes over and then scale kicks in and you can't grow like you used to. The lifeblood of America historically has been small businesses, because that's where you get that really big growth. Because one business who doubles his workforce from 10 to 20, it's 100% increase. And then you have like, a big firm hiring 1%. Yes, their scale is larger, but that doesn't create growth momentum. I like this one great analogy. It showed a village. There was a scientific study. It showed a village in Vietnam. And they, back then when they would collect the rice paddies, they'd have their big upside down, they'd have their big upside down hats, and they'd put their rice extra and walk it back and forth. They gave them one truck, just a 4-wheel drive truck. It increased their productivity some 300%, just one truck. But imagine giving another USPS today, the big FedEx or whatever. Imagine giving them one more truck. You won't see their productivity increase even in the slightest way, because they've already expended so much energy. They're already in such a scale that everything has marginal. You get to a point of law of diminishing returns, and that's what we've seen with big firms. They get to a point where same with the government. The bigger the monopoly, the more you invest, the less marginal returns there are. It's actually becoming negative at this point. The government pumps so much money in and all these things, and they're barely squeaking out growth.
Okay, so there used to be a lot of brokerage firms as well in the U.S., and that's been the baton death march, and they knock the little broker dealers, make it so expensive they don't want to stay in business. And what do you think the effect's going to be of the new legislation and all these new IRS agents probably going after the small businessman? I hear that's one of their targets, the sole proprietor. That is only going to exacerbate. We need them to thrive.
I agree. And in my opinion, no, you're right. What is it? The Inflation Reduction Act, the most improperly named bill
ever. It's an oxymoron.
It is an oxymoron, and in my opinion, they're adopting see, this is an MMT fallacy, which they've shown
named by a moron on Oxy.
Yeah, more or less. And all the cronies too, getting paid by Purdue, and they get they're adopting the MMT style from I forgot the lady who wrote it's a really atrocious book for anyone who wants to really read The Deficit Myth. Reading it will give anyone who understands like basic economics, it'll give you a pounding headache, but it's worth reading what the hype is about. But this was before 2020 came out, and the thesis is, oh, if inflation's running hot, the government, not the Fed, just needs to suck money out of the economy via taxes, which it doesn't really make sense because the government, it's not like they're canceling those dollars with taxes. They're just redistributing it. So if I was going to go out and buy a new car with that money that I got taxed with, the government's going to spend it where they want. So it's like a zero-sum game. It's not, it's not like you're just taking that money out of the economy. So the Inflation Reduction Act, they're like, oh, we're actually going to increase the deficit in the next few years, but in 10 years that are balanced. Well, Jesus, if we listen to politicians, every 10 years, the budget would be balanced. They do this. They're like, oh, it's going to be balanced in XO years. And then a little bust happens. And then they end up like a COVID or 2008, 2015, et cetera. And then they have to end up printing trillions more, running trillion massive deficits just to get the same eked out 2 to 3% GDP growth that they can barely get.
So as far as optionality goes, Adem, and I know that's your forte. Last time we talked, you were a contrarian. I don't know if it's still working. You were getting long, I believe, F.A.C.E or something in China.
Yeah, that hasn't really. Yeah, China's been a basket case. Let me even see what the X is. This is lower than I even bought. Those options are probably going to expire worthless because I was reading how China's data has been so bad with COVID, and I'm seeing that they're trying to take out certain stocks out of the major indexes. So
all right, forget the post-mortem on that.
Right?
I mean,
at least long bonds was something that's worked out because that was another thing I was going to say is the inverted yield curve. It's more inverted now. It's basically about to hit like a 40-year low. I think right now 1998 has the highest at like 0.45 negative. Right now we're at 0.43, and it's rising every day as the Fed continues hiking. This thing's going to keep going deeper. And for individuals not aware, the inversion of the yield curve curtails bank lending because banks use the yield curve as a proxy because you borrow short, lend long. But if the Fed is arbitrarily hiking up the short end of the curve, and then you have investors seeing it plant the seeds in the next recession, because since the 1980s we've been such a credit-fueled economy or global economy in that aspect. Like I was hearing you earlier with the stocks going up, the data is looking pretty grim, and it's just going to go lower in my opinion because of lag effects. But individuals are pricing it in stocks because from now on it doesn't matter. Growth doesn't drive equity prices or asset prices anymore. It's not like the old days where if it grew, your assets increase. Now it's just the flows of liquidity. So if the central banks are easing, boom, pumps up asset prices. Doesn't matter if your economy is doing good or not. I mean, they're correlated, but either way. And then if they start hiking, even if you have positive growth, you're going to see asset prices plunge, which we saw with Bitcoin. Cryptos, NFTs, all down like 50, 75% since 2022 started, just from the Fed tightening.
Okay. So you like the bond market? Does this make you kind of a deflationist? The opposite, except a lot of people are buying peak inflation. Is it?
No, I think we hit peak. I wouldn't say smart. Maybe I got lucky, but in June I said that was going to be peak inflation growth, just because since June, because as we've talked about in the past, employment and inflation data is all lagging. And then when June's data came in, we're already halfway through July at this point, and we've already seen oil. Oil was around like almost $7 a gallon. Now it's almost at $4, right? And then we saw Biden was touting it like, oh, there's been zero inflation, even though that's disingenuous because it was just 0% monthly. But in year-over-year terms, it was like almost 9% still. It was 8.5. But I think we hit the peak in inflation in June, and we're going to see it just trend lower. But the insidious part is that even if inflation is zero, let's say monthly change zero for the remainder of the year, inflation in year-over-year terms is still going to come above probably 6%. And looking at the Fed, they're probably going to keep hiking. They're going to hike us into a recession. They're going to rip their nose off to spite their face, in my opinion.
Okay, another policy error. So how do you take advantage of? How do you make money with what you're seeing across the landscape in the markets?
So when the yield curve was at it was at like 0.2. I was like saying like, hey, I'm going long bonds via optionality, just lock it in, because it's a bet. It's basically we're calling the Fed's bluff, because the assumption is you're buying. So why the yield curve inverts, for anyone who's not familiar, is that so the Fed hikes up the short-term rate arbitrarily. Like, you know, there's like the market actually does thing when there's like news. It's like the weighing, like Ben Graham used to say, it's a voting. It's not a voting machine in the long run. It's a weighing machine. In the short term, it's a voting machine. In the long term, it's a weighing machine. So when the Fed just comes in and like, hey, we're hiking rates 0.75%, you know, they just arbitrarily pick that number out. There's, you know what I mean? What makes the difference between 0.5, 0.751? I mean, they maybe have some math they explain, but they're arbitrarily hiking it. And you have the long end of the curve, which is betting against them, saying, well, you guys are pricing in higher inflation, higher growth from, meaning we need higher rates for the future, but we actually think you're planting the seeds for the recession. So we're buying the 10 and the 30 and the 20-year bonds, et cetera, which pushes prices lower because we are assuming that there's going to be deflation and a recession in the future, which you're causing because of your hikes, which is going to slow down the credit and slow down the economy, et cetera. And you're going to be forced to cut again, which is going to make those long-term bond locks in. Like if you're locking in a 10-year bond, locking in at 3%, you know, and then 2 years later, the Fed cuts 10 years, the 10-year, I'm sorry, they cut the Fed funds rate, whatever, and do QE, and it brings the 10-year down to 1.5. I mean, you're happy you have that 3% locked in for 10 years. So that's how inversion happens. It's the long end of the investors calling the Fed's bluff, more or less. And we've seen yield inversion precede the last 8 straight recessions. And it makes sense logically and empirically. And I think we're going to see it again, especially with how deeply it's inverted. I think.
Do you think we're in it, or do we have to wait for the lag time of Fed policy to filter through?
I think we're in it at this point, but it's just because they keep hiking. So there's like usually a 6-month gap between these things. So even if the Fed started cutting rates today, there really probably wouldn't be an economic benefit probably until I'd say like January at the earliest, right? And like we saw that with them tightening, you know, it slowed the economy and growth down, and everyone started talking about recession basically in summer once they started hiking in December. And they're aggressively hiking for this. I mean, for how much credit and marginal debt is in the system compared to other cycles. Leverage, yeah. They're really high. If the Fed was ahead of the curve,
the housing market is feeling it, isn't it?
Yes, the housing market's definitely feeling it, and the housing market is like the home builder index recently fell below 50, meaning it's in contraction, and it makes sense because obviously higher rates going from, you know, let's say the 30-year mortgage rates were below 3% for a whole year, pumped up. I think historians are going to look back in time at the Fed's policies after COVID for home owners and they're going to just be scratching their head. Like, why the hell were they doing this? Like, they inflated a massive housing bubble within just a year's time. Like, why were they buying $2+ trillion in mortgage-backed bonds?
Yeah.
So I think that's going to be a
what are you
blunder.
using as a proxy for bonds? TLT?
Yeah, I like to use the TLT.
Okay. Just wanted
longer end of the curve. It kind of allows you to take advantage of, because I believe in structural deflation, like we said. You know, we see China running China's back to running. I'll pull it up actually.
How about the dollar here, Deb? Do you think that we peaked at 109 and we're in a topping phase here?
You know, it's hard to say. I don't think so. I think it'll go higher for the midterm, and I think if there's some kind of black swan, we're going to see the dollar go higher, which is interesting because for how much inflation there is compared to the 1970s, where we had a weakening dollar, like every country in the world was dumping dollars, we're having the opposite today. We're having, you know, investors load up on dollars. So I do think we're going to see the dollar. I do think we're going to see the dollar go higher, but I think it will eventually hit a point, you know, maybe like 115. I wouldn't be surprised, but if it did turn and the Fed starts cutting, I wouldn't be surprised, but I don't think it would drop back down deep into the low 90s.
Okay, and the yen is pretty tightly correlated with rates, so if you're looking for rates to come down long term, there must be a nice short in the US dollar yen.
Yeah, that is true. I need to look more into that. Yeah, I need to.
You know what my commission is on that one?
What is it?
I'll talk to you later. I'll send you.
Well, thanks for the insight, and we'll have to discuss it. Okay. Yeah, so the China current account, like, you know, their surplus versus deficits, they're back to running surpluses we haven't seen since before 2008.
Who is?
China. Yeah, I mean, because when their investment, so basically, Michael Pettis wrote this brilliant book called The Volatility Machine, The Great Rebalancing, another book, and his most recent book was Trade Wars or Class Wars. And in it, he's in my opinion, one of the most intelligent. I mean, he lives in China and teaches there, and he's one of the most impressive economists that actually understands real world markets and economics. He was showing that when China has such large surpluses, it's because they have an underconsumption problem domestically, meaning they're producing so much stuff that their people aren't consuming because they're not wealthy enough that they have to export the glut. Germany does the same thing. Germany in 2020 or 2019 ran the world's largest current account surplus, and they're producing more that they're not consuming, and they're dumping it on the rest of the world. Well, that in fact is deflationary because you're forcing the rest of the world to absorb your glut. That's why when the Chinese yuan in 2016 weakened, when they cut the yuan, you saw there was a big deflationary crash in markets because that's making their exports even cheaper for the rest of the world to absorb.
Well, that's starting to happen now, isn't it, with the yuan?
Yeah, we are starting to see that now. Yes. And that's why it's no surprise that we're seeing, like on this chart shows, like 2008, we saw basically their current account surplus peak, 2009-ish, and now it's back to those same levels. For the last 10 years, they were trying to reduce their deficits. That was the whole point. Like they were their current account surpluses. I'm sorry, they were trying to reduce it. It was trying to not, they were consuming more as they grew wealthier, so they didn't have to export as much and et cetera. But now they're back saying, hey, we can't get the high quality growth. We're having a housing bubble implode. We need to still hit our growth targets. How do you do it? Exports. That's why Russia, a weird thing is Russia is a surplus running nation since 2015. They have a current account surplus. So when they did these sanctions on them, they were targeting their imports. But when you're a surplus nation, you should be targeting their exports. But since they're such a commodity exporting country, it just shows how hard it is to do sanctions on a current surplus country. And America, so when you're a big country like China and you're dumping a glut of goods on the rest of the world, China and the European Union via Germany, you need people to absorb that debt. So when someone's running a current account surplus, that essentially means someone else, various people maybe, or one big group has to be running a deficit. Someone has to be buying that glut. And America has been buying, essentially importing all these cheaper goods, absorbing the glut from China. And it's, even if America tried doing like Trump did, like homegrown in America, whatever, we're going to stop importing from China, that's not going to fix the problem of underconsumption in China, which is the biggest marginal growth engine in the world. I mean, since 2008, between 2009 and 2018, China alone accounted for 50% of the world GDP. It's that saying, if China sneezes, the world catches a cold. Yeah, and their entire economy is slowing down. They're basically sliding into a debt deflation cycle, in my opinion, because the average Chinese, they don't have like a savings or pension or social security like in America. So when their largest asset is a second home, that's literally where their wealth comes from. It was like some 80% of Chinese, their wealth or their savings, whatever, for future retirement. And mind you, there's over 700 million Chinese that are supposed to be retiring in the next 5 to 6 years. That's more than double the US population, that they're put all their money in a second home. But now we're seeing home prices decline. And, we saw how that worked out for the US and Europe and globally in 2008, when home prices even start dipping slightly, it amplifies downwards. You have the marginal sellers get out, people who can't pay the loans, pushes prices lower, but gets more selling because individuals don't want to get let out. Your liquidity piles up, you see prices really sink. And God knows, I mean, it's so bad in the US they're trying to cancel, student debt. They're trying to do whatever they can. They're having student loan pauses and everything. They're going to probably just keep doing it, which is an insult to anyone like me who didn't go to college. And I feel individuals who did, and it sucks. But at the same time, the US government is essentially subsidizing. So to put it plainly, individuals like me who didn't go to college, on average, just going off of history, will earn less than a college student. But yet, by bailing out the college student, you're subsidizing a college student in debt who will make more on average than a non-college employee, non-college graduate. So you have the poor subsidizing the rich at this point. And that's not a sustainable system. Also, it doesn't fix the problem going forward. Let's say you canceled all the debt. Well, it's not like people are going to stop going to college, and those tuition prices are probably only going to double knowing they get a bailout next time.
Yeah, I had to pay mine.
Right?
Anyway, Yeah. So, Adem, so much information. People are going to have to replay this interview. Best idea going forward until we talk next.
Well, I'm waiting for this bear market rally I think it's a bear market rally, and I'm looking at puts on car makers, home builders. I think they're dogs with fleas at this point, but like we just talked about, growth and economic data doesn't really drive it anymore. It's credit flows. And I think the Fed is committed to still tightening, and it's only going to make this pain and these lagging indicators, by the time we see inflation get down to 2%, we're probably already deep in a depression, I'd imagine.
How far out do you go out to put on your option strategies?
I try to aim for at least minimum 8 months, 8 to 15 months usually, if I can lock it in real cheap, just off of using heuristics. I like to use the Mark Spitznagel and Nassim Taleb heuristic model compared to like Black Skulls or the binary option pricing model.
Okay, let me know when you pull the trigger, and why don't you show your website real quick? And
oh yeah, sure, I appreciate it.
Yep. This is where you could find Adem's website. You can find him on Twitter at Radical Adem, ADEM, and there you go. There's his website. And if you want to, if you need to exercise your brain, I know a lot of older people do these different types of brain exercises. All you have to do is read Adem, and that'll make your brain work. So I really appreciate you being here again, buddy.
Yeah, thanks, Dale. It's always a pleasure to have me on, and I hope to talk with you again.
We'll do it. I'll get a hold of you on Twitter, and so Adem the bear looking to fade this rally in S&Ps, and deflationary and a housing bear as well. Thanks for sharing your ideas with us today, buddy.
Great. Thanks for having me on, everyone. Have a good day.
All right, my trading warrior brother, Adem. Radical Adem Turkman. Is that correct? Your last name?
Tamerkin.
Well, not bad for live TV.
Anyway, it's a Turkish name. Everyone pronounces it wrong. I appreciate it.
And go meet Blake. It'll be, get a hold of each other.
Yeah, we're gonna have to get coffee soon.
Yeah, and that's a wrap, everyone. So don't just count your bearish narratives, count your blessings, and we'll see everyone tomorrow. I have Angie, goddess of grains, with us tomorrow. If you haven't noticed, the grains have been getting hammered, and I'm thinking that we could be close to some type of entry. So see you tomorrow. You could join the team in 13 minutes on the morning edge. You're welcome, Jeff, Sinatra. Thank you for being with us today, Adem, and thank you everyone for your attention and support. The way to say thank you for what we're doing for free on F.A.C.E here is to join our